Let's quickly talk about a Chinese company, PetroChina, which is kind of like the listed arm of a big Chinese state-owned oil company, CNPC. Remember, in China there's CNPC and Sinopec, and for one reason or another, this is the portion of CNPC which is listed in Hong Kong. It's also got an ADR in New York, where it has a market cap of $210.1 billion. Price earnings ratio 38.89, dividend yield of 3%. While the chart comes up though, what is happening in China at the moment is we've got that Congress going on. Xi Jinping looks as though he's going to be elevated to the same status as Chairman Mao or something.
Yeah.
He apparently is like quite positive towards private companies, but he's sort of turning the screws a bit and saying he wants everybody to acknowledge the significance and importance of state enterprises and so on.
Well, look, I think that's quite normal, but maybe equally as important for these companies and the whole commodity market is he's cracking down massively on pollution. Massively. I mean, a bad day in London, you get, I think it's 4 parts per million pollution. Bad day in Beijing is 350 parts per million.
Now, I've been there. It's a problem. So
a serious problem.
You can have a good day where you can actually see something in the distance, and on the bad days you literally cannot see anyway. And it's
so
because of the broader use by cars of petroleum fuels and then also the burning of fuels in the industries around the Beijing Valley.
The whole area,
Okay, but what happens with this one? I mean, we've typically, when we've discussed Chinese companies, said, you know what, the problem is, who the hell knows? They will do a new 5-year plan, and they'll say, this is what your profitability will be.
And this is where you'll go.
And by the way, we want you to invest in this company, which is state-owned in that province and it's having a mess, so we want you to take it over, so on and so forth.
Yeah, look, it's not quite capitalism as we know it. But one thing we forgot to mention, I forgot to mention, in the whole industry overview, is all 3 of the big oil majors have reported declines in their physical output of oil. Increase in gas, but their oil output is declining, and that's not intentional. That's because their conventional oil fields are aging. So they all show 1 to 3% decline, despite some capex. They're all declining, and this one is exactly the same. But
although we know that there have been some marginal additions. So, for example, Iran is back in the market. Iraq took a while to rebuild their production, and those are big resources, and so on. Libya, of course, is another one.
But even then, it's easily absorbed. There's actually no surplus in the market at the moment.
So there's big demand for transport fuels. The Chinese have a little bit of their own production, but these companies are expanding internationally. They've invested in fields in East Africa and all that sort of stuff.
All over the place. But once again,
hot or not on this one?
Cash flows are 3 times the earnings now. Go not hot,
Yeah, I think that's the correct move. I mean, first of all, the chart doesn't look great at all, and obviously there are bigger fish being fried here, and you might be the minority shareholder that buys them and get fried alongside.